G'day Australia, welcome to My Millennial Money. Today we're following on with a bonus edition. We're talking about trusts. So it is a matter of trust, isn't it, this one, John?
It always is. Always is.
Welcome, John. And welcome back, Scott Young from Altus Financial.
Welcome, Scott.
Thanks for joining us again.
Thanks for having me, guys.
So as a bit of a... before we get started, I want you to, if you haven't heard the episode on business structures, episode 257, it's probably worth going back and listening to that because we went through, sole trader, partnerships, companies, and then we're moving on now to trusts. So we're going to try and unpack trusts today, I guess from a small business point of view of why we might use them and all that stuff. But then we're going to talk about using them as investment vehicles and basically just get down and dirty with trusts, okay? Yeah. Now, if you are listening and not yet watching, we are on YouTube. So if you go to My Millennial Money, you can see M3 TV on YouTube. We're filming this episode. So what up, everyone? G'day. And we've got a diagram. So there'll be a link in the show note to one, the YouTube episode, but two, also a link to the trust diagram that I've drawn, which is a basic diagram, because this can be complex for people who just don't do trusts every day. I mean, it's probably a little bit more advanced, and it's certainly, Scott, you wouldn't recommend someone just jump online and set up their own trust without some accounting and legal advice.
Definitely, Glenn.
So trusts, well, any business structures, just some motherhood statements, usually you'd want accounting and legal or estate planning advice before you just go and run and open something. Is that correct?
Yeah, look, I think that's right, Glenn. I think at least it's really easy to think that you require or need to set something up without first seeking advice or having a discussion to understand the pros and cons of doing it. I think my primary statement on structures, whichever they are, is they need to serve a purpose. And ideally the benefit, whether it be a short-term benefit or a long-term benefit, needs to outweigh the costs.
Yeah.
And the benefit is to you and not the person recommending that you set it up, right?
100%, John. You're absolutely right. It's really easy for experts and practitioners, and there's many great ones out there in the professions, but it's really easy to overcomplicate things without properly sitting down. And that's where I think, Glenn, you're right, that the goals-based advice of understanding what are the goals and objectives, whether it be in business or investment, and then ideally ensuring short, medium and long term, and then making sure the structure helps serve those purposes first and foremost.
Yeah. So, and I will say before you turn off, we are talking about trusts as an investment vehicle as well. So if you are an employee and don't plan to ever start your own business, you will still learn the concepts, and you'll probably learn more about trusts when you hear them talked about in movies or in TV shows or in the news. So where we left off in episode 257 was basically a progression from sole trader to incorporated. So as a recap, a sole trader, what's a sole trader? Just as a quick recap.
Yep, quick recap. Sole trader is basically an individual carrying on business in their own right. So there's no separate entity or structure from themselves as an individual, and that's as simple as you have a tax file number. You go out there and you need an identification to state that you're carrying on business, which is an ABN. You then potentially have to be registered for GST, but in effect, it's an extension of yourself. You're carrying on business. You can register a business name under your personal name, and that linked to your ABN gives you the right to trade under that identification.
Yeah, so because I'm a visual person, being a sole trader, just imagine a funnel. All income is going into that funnel and it coming out of the bottom with the same tax file number and an ABN. Where if you go, okay, well, we need to grow this side hustle or turn this business up a notch, we might incorporate, which would mean essentially a separate entity with its own tax file number and its own ABN. So you can picture two funnels in the sky now, but your personal funnel might be under the big funnel.
So a common question with that, Scott, is I'm a sole trader, basically self-employed. Can I distribute income to my wife through that structure?
Well,
We'll get to that.
yeah, no, but good question. The answer is really no,
Yeah.
right? In most cases, therefore, John, you're saying I have reduced flexibility,
Yep.
right? Majority or if not all income earned by you is derived by you and accessible to you.
Yep.
So there's limitations in relation to that. There's also limitations in relation to the tax rates that's paid because you're paying it in your own right. And back to your point, Glenn, there's no separation of risk from yourself as an individual and your family home that you may own or any other assets and your commercial trading activities.
Yeah, and I think it's important to know with moving from sole trader to the next thing. So it's more of a, okay, I've tried my business for the first couple of years. I think it's going to be a success. I think I need to take it to the next level. We need to think about tax planning and asset protection.
Yep.
And that's not to say, you might, if you're a contractor, you might have to have a company because the people that are paying you only will pay to a company. So forget that. But as a natural progression, trusts can be seen as more flexible in terms of estate planning and possibly tax planning. But there's pros and cons of each side of the fence.
Yep.
So
Which we'll go deep with.
which we're going to go deep. So again, jump on to the show notes or on YouTube. We'll put it on the screen, the little diagram that I've got. Now, when you need to know information, where do you go? You go to Wikipedia, right?
Always.
So I just Googled to get a succinct statement. What is trust law? And a trust is a legal agreement where a person, which is the trustee, holds and manages property for the benefit of others in the agreement, which is the beneficiaries, as laid out in a trust deed. The trustee legally owns the properties but is obliged to act in accordance with the provisions of the deed. So I guess if, John, you had a brick in your hand, we could call you are the trust and you're holding the brick, which is an asset.
Yes.
Scott, you are the trustee. Now, and then on the bit of paper on the floor, there's a document in a binder called the trust deed. Mm-hmm. Now, Scott, as the trustee of that trust and the brick, you need to manage John holding that brick in accordance to the trust deed. But he's holding that brick for my benefit being a beneficiary. Is that a practical way
Absolutely.
to explain it?
Yes. So basically, we have different roles or different duties and responsibilities. So the deed is the governing document that basically says each of our roles and what we can and can't do.
Yeah.
The trustee, which in that instance was myself, I have to administer the trust and its property in accordance with that deed. Otherwise, I'm not fulfilling my duties as a trustee.
Cool.
Yes.
So just before everyone turns off this episode, we don't want to overcomplicate things, but do you get people come to you and say, well, that's all just too complicated, just keep me as a sole trader, or I just want to keep it straightforward?
It's a really good question. You'd actually find, John, to all our listeners, it is complex. But the question around trust and why I should have one, should I have one, I saw a friend at the barbecue and they've got one, comes up a lot. So, and the main reason is because there are benefits to it, potentially commercial benefits that can be annuity-based, obtained every year for a long period of time. So I think it is a common question that people probably don't quite understand down to where we want to talk about is when would one be suitable? When should I have one?
That's the key, isn't it?
And potentially, when am I being sold or discussing something that's probably not something I require right now in my life?
Yes.
Yeah. And I guess as well, and maybe we can use that example, but if you are driving at the moment, just imagine a bit of paper on the page, and there's a triangle in the middle, which is the trust. And then on top of that triangle is a rectangle, which is the trustee company. Now, and we will get into the trustee because it's important to know. And then also on that bit of paper, there's a ring binder, which is the trust deed. Okay. Now, I think for the benefit of understanding this, it's probably good that we just, for the sake of this conversation, I'm the beneficiary. John is the trust. John is holding that brick, which is the asset. And Scott, you are the trustee that's making sure that John is managing that brick in accordance with that ring binder, which is the trust deed. Now, that brick might generate income each year, and
maybe it's a gold brick.
It's a gold brick, and it prints money, and I'm the beneficiary of this trust. So you make sure that the ring binder trust deed says Glen is the beneficiary, so he gets the benefit year on year, and also if the asset's sold. Now, again, we don't want to complicate this too much, but let's just step back. And most people say, I've heard of a trust and I've heard of a family trust. So the street name is probably family trust, and the professional name is a discretionary family trust.
So there's plenty of ways we could spin this, but in this example that you've just given where I'm holding the brick,
yes,
in a family situation, who's Big Daddy here?
Could be Big Daddy,
yeah,
and we'll pretend that my wife Taylor Swift,
you
are managing that brick, and that brick could be a company. It could be a share portfolio, but for this conversation, we'll assume that that brick is my business.
Yes. So, and I'm Taylor.
No. Don't. I don't even think we should joke and confuse the complexities of this. So, Glen and Taylor Swift. So what about I give an example of my actual business and how I use the trust?
Yeah, and why?
And why? And this is because we had to do this as a separate episode because we can't just gloss over this.
No.
And you need to get professional accounting and legal advice. So I started my financial planning business in 2010, okay? And like any business startup, we want it to be lean. We don't know if it's going to last 3 years. We don't know if it's going to last 5 years, okay? So it was easier for me just to start and trade as a sole trader. So my business, Glen James Financial Planning, trading as Glen James Financial Planning, okay? So, and that was it. So all the income that I generated, and there was so much in the first year. So because I wasn't earning much income, the expenses weren't great, I'm just starting. So all the income I generated fell into my lap, okay? And then most businesses is considered an asset. So if you've got a barber shop and you've got 3 chairs, that you could sell that barber shop because it's got recurring income, because you've got customers, they've got equipment. So your business can be seen as an asset, okay? So a little bit different if you were a tradesperson just doing ad hoc trades, but the nature of my business was I was building an asset because it was recurring customers, recurring revenue, staff. It was
a brand.
It was bigger than just Glen James, I will fix your lights. Okay, so I decided, so it was a couple of years in, 2.5 years in, I had a meeting with my accountant and solicitor, and I said, look, I think this has legs. The signs are pointing north. This is really going ahead. I need to now incorporate. Okay, so we had to look at 3 basic things. And if you've got any questions you want to ask, jump
continue,
in.
Yeah.
3 basic things. Number 1, tax planning. What was the most flexible way for me to legally pay as little tax as I was required to by law? The second one was asset protection. So if I set up a life insurance for somebody for $1 million and it didn't pay out and it was because of me being neglectful or whatever, and the PI insurance didn't cover that, because you've got to look worst case scenario. How do I protect my assets?
Yep.
So, and then the third one was if I ever had to sell that business or that asset, because the nature of my business, I was building a legitimate asset that might be able to be sold one day.
Yeah.
Okay.
So would there have been a fourth one in terms of income distribution?
Well, that's just tax planning. That's the
okay,
first
so
point.
you put all that under one umbrella.
Yeah. So tax, income, second, asset protection, third, end of transition, or what would you call it?
Well,
succession, even.
Yes, succession or likelihood of realization or transition of value.
Yes.
Right? Like the example you said before, if I'm building a business just for a lifestyle, which is really not going to be above and beyond the individual.
Yeah, like I could have a lawns mowing business.
Yes.
Like probably keep that as sole trader because it doesn't have any value, maybe $1,000, $3,000 worth of mowing stuff.
Yeah.
Because I am the business.
Yeah.
Where the business I was building had staff, it had a brand, it was,
So, question for you, Scott. Why would Glenn have set up the whole shebamble at the start, trust, with Glenn as a beneficiary, etc., as opposed to him going sole trader at the start?
Probably because I think he wanted to crawl before he walked.
Yep.
Yeah, and that's very common. John, that people aren't quite clear. They're maybe not as confident as just going all in.
Yep.
Whereas you that's just the attributes or the different characteristics of people. Some people walk in and go, I'm committed to this. I know it's going to work. I'm all in. Let's set it all up. Whereas other people go and say, look, I'm starting up.
because it did cost me a few grand.
Yeah, I was going to say I only have so much capital I want to deploy
to set that up initially.
Yeah.
So I might let me go and prove to myself this will work. Maybe they've just exited. They're sort of putting one foot out the door from employment. So they're going, I want to step out, keep as much capital I've got because that's my savings base. Not only, Glenn, are your costs more expensive on the setup, but your costs are also more expensive to administer each year.
Because you're basically starting a company.
Yeah.
Or you've got an incorporated entity that needs its own financials, it needs its own tax return. It adds costs. So the advice that I had was to set up a discretionary / family trust as Glen James' wealth creation, wealth vehicle for the rest of his life. Okay. Now, there are two types of trusts that we will talk about today. The family / discretionary trust is one type of trust, and the other trust would be a unit trust.
Yep.
Okay, so the way I set up my business was a discretionary family trust, and which was just for Glen James, and the Glen James financial planning was set up in a unit trust, which all the units were owned by the family trust. So technically speaking, with a unit trust, all of the money, distribution, other word, maybe dividends, if you want to call it that, just for
profits.
Profits is probably a better word. All of the profits from the financial planning business had to go to the unit holders, 100% of the unit holders evenly over the units, which was my family trust. But because my family trust, and if we go back to if John's brick that he's holding is the Glen James financial planning business, now that brick being the family trust, it's a discretionary trust. So all the profits, it's at the discretion of the trustee to distribute that profit. So Taylor could get some profit. Glenn could get some profit.
Glenn could get none.
Glenn could get none.
Yeah, and then down the track, your kids may get some as well.
Get some. So the advantage of the setup that I had, so John's holding the brick, which was Glen James Financial Planning, which was a trust in its own right, which is probably doesn't really matter for the purpose of this. Glen James himself, I did not own my financial planning business.
That's correct.
So, and that's why you see on the news where like people get sued and go bankrupt or whatever, or they get sued, probably not bankrupt, but they're still driving around in their Maserati, or they're still living because them personally didn't own any of the business assets.
No, they just took a distribution over time.
So as you can see from the setup that I had, one, asset protection, because I was in a highly litigious, whatever the word is, industry. So big risk.
Yep.
So if I did something wrong, it could cost hundreds of thousands of dollars. And two, I had more control with distributing profits within my family unit. So
question for you, Scott. In that example, setting up as a trust, are there certain industries that have got different regulations in terms of the person on the front line needs to be insured, so as a result of that they need to be a sole trader or whatever? Have you got an example?
Absolutely. And you're seeing more and more of this where commercial complexity is forcing the use or no longer ability to utilize different structures. So there are many corporates that will say we do not contract with sole traders because of the risks associated under insurance, workers' comp, superannuation. You're also seeing heavy in the construction game where they may not contract with trusts, but it's commercially acceptable that they may be requiring people to trade as companies.
Right. Yeah.
Yeah. So I think if you are looking at that triangle that we've got the diagram on the link, and we'll put it up now on the video, that triangle itself would have its own ABN and tax on number. Now, Scott, what are the big things, I guess the key differences between a company trading, so if Glen James Financial Planning was a company versus Glen James Financial Planning, even if it was just a discretionary trust?
Yep.
What are the one big difference with the two entities in terms of tax?
Yeah, well, tax primary is a company has its own tax rates, right? So either a company pays it at 30 cents in the dollar or 27.5 cents in the dollar. That means that every dollar that the company produces as profit, the company must pay tax in its own capacity. Okay.
Yes.
Then what happens each year is then the company can distribute monies through to shareholders. So the profits are captured within the entity, and then a discretionary decision can be made to distribute them. The company has no obligation, unless its constitution says it must, it has no obligation to pay that money out. It could reinvest it, it could retain it, it can do whatever it wishes as per the board of directors. On the other side, when you've got a trust from a tax perspective is a flow-through vehicle. So what I mean by that is that it is in its own right owning property, in this case a brick, and then generating income off that brick. So it could be renting it, it could be selling part of it. But each year, the trustee, being myself in this instance, must decide how the profits are generated, are distributed through to the beneficiaries, being Glen and his family. Now, if I choose to not do that, then what happens is the tax system basically penalises the trust and deems the highest marginal rate on that income. So in my game of doing this for over 20 years, we haven't had a trust that has not made not distributed, because the implications of it are basically adverse in that right. So in effect, what we're saying is in the company's perspective, it's a fixed amount that's paid by the company. In the trust perspective, it's a flow through at its discretion, in this case, to the beneficiaries each year. So long story short, companies pay tax, trusts don't pay tax. The beneficiaries receive the income. So, and this was a hard one to get your head around. So if that brick generated $100,000 in profit for that year, and at the 30th of June, there was $100,000 in the trust's bank account, because the trust, the triangle, would have its own bank account. Yep.
That $100,000 profit has to be distributed to Glen and Taylor, Glen or Taylor, whatever it could be 50-50. Now, the thing to get your head around, the actual $100,000 cash from the bank can stay in the trust, but there has to be a deemed income on paper on my personal tax return and Taylor's tax return of 50-50, or we'll just call it $50,000 each.
Yep.
Now, you can start to see that if Glen James earned $100,000, I would pay more tax as a family unit as opposed to Glen earning $50,000 and Taylor earning $50,000 from the trust, because we both get our $18,000 tax-free.
Yeah,
That's correct.
different thresholds.
Now, there are some differences, and we will just slightly touch on it. If you distributed, depending on the business, there's a thing called personal service income. So if you were a single practitioner web developer operating out of a trust, and your partner was a dentist earning their own income in their own right, talk to me about that $100,000 profit from that brick. That if that brick was the web development work and I was the web developer and Taylor was a full-time dentist earning her own money in her own right, we could not necessarily split that $100,000 two ways.
Yeah. So basically what those rules are looking at is when the services are basically rendered by an individual in their capacity, and it smells and looks and feels like an employee-employer relationship, but you're just using a structure to obtain a tax benefit. The tax system basically defines it and says, look, we respect the fact that commercially you may wish to utilise a structure for the benefits you said before, like asset protection.
Yeah, so it could be a risky web development business where he could maybe lose his ass.
Yeah. Yep.
Yeah.
Or maybe he couldn't get PI insurance
Yes.
or something like that, so he had to set up a structure. But the way it's looked at from the tax system is they say, well, there's a test that you need to pass or tests you need to pass, and if it looks and feels like Glen is basically just an employee, then Glen is deemed to have received all that income.
Yes. So
To basically stop people from avoiding tax.
That's it.
Yeah.
That's exactly
and
right.
then that's the benefit of tax as an asset protection estate planning vehicle. In that instance, I've done it to protect other wealth in the family or whatever, because it's a trust and it's not me individually, doing the web services. It's the company or the trust doing the web services, but we can't use it in that instance for tax.
That's right.
Where my business was a legitimate business, there was multiple employees, it was...
Yeah, you had premises.
It was its own thing. We could then distribute that income to the beneficiaries.
Yeah.
Yep.
So, and going a little bit deeper on that, would the ATO request a business plan in the event of an audit and something like that, where they actually dig really deep into your structure of the business and how you run it on a daily level?
Yeah, look, there's a number of tests there about, and you're right, whether you spend a certain amount of assets, whether you've got it from one or more customers, right? So if I'm a web developer and I only work for one company, and they tell me the hours to work, I work in their office, it's 9 to 5, like that feels like an employee. If I work for 5 different companies over a year, the fact I work from home and then of course if you have business premises, right? Those types of things define where you sit on those rules. I think the other point, just Glenn, to touch on about beneficiaries is that some of our listeners, could be beneficiaries of maybe family trusts that their uncles, aunties, mums and dads have had. Maybe there were periods where they were just turned 18 or in their 20s and they were getting distributions but didn't quite understand how it all worked.
And didn't see any of it.
This sort of links into that conversation as well.
Yeah, and that's it. So a discretionary family trust, which is a hybrid of the two words, like it's a family trust and a discretionary trust. The trust deed, the ring binder on the floor that Scott, the trustee, makes sure that everything operates via that trust deed, that could say it would list the beneficiaries. So we could distribute income to different, like as an example, my grandmother, I'll just use a wild example, she 100% lives off the land, is not on social security, doesn't have any wealth to her own name. I could distribute and give her $50,000 a year out of my trust because she's a family member
Yep.
and she's listed in the trust deed by way of her title being grandmother.
Correct.
You can also distribute to charities, churches, religious organisations through your family trust. So the key thing is having a trust deed that's current and reflects your situation.
Yep.
So, there's a lot of ground that we covered there.
Well,
So-
why don't we maybe talk about the difference of where a unit trust is maybe a little bit different?
Yeah. So, well, actually, before that, I just wanted to touch on, if you're looking at the diagram and there's the trust. Now, on this diagram, that there's a link in the show notes, and we'll put it up on the video again. The trustee company, and all my trusts have had trustee companies, not individuals.
Yep.
Why would somebody use a trustee company? So the company, we're removing Scott as looking after the ring binder on the floor, and we're inserting a different company in there,
Yep.
which doesn't trade, is just a shell company. Why would we use a company as a corporate trustee?
Yeah, look, good question. You started this by saying that the assets are actually listed in the trustee's name, which is absolutely correct. So, say for example, this trust that we've got in the brick's a piece of property.
Yes.
That would mean if anyone conducted a land title search and I'm the trustee of this trust, it would actually show that Scott Young owns this property. But fundamentally, I'm not the owner of this property. I'm actually not a beneficiary of this property.
Yeah, you're just making sure the rules are played for within the trust.
That's correct. Whereas, so that can cause confusion.
Yeah.
It can also cause complexity on both our fronts. Yeah. Additionally, if something was to happen to myself, pass away, death, there's a whole myriad of problems that sort of can occur. Equally, in that instance, there's only one individual that's making all the decisions, right? Whereas what people move towards is a trustee company, which then can have various directors, it could be 2 or more, it could be 5, that are basically making decisions in relation to the trust. And also it means that the assets are not listed in the individual's names, but are listed in the trustee company's name. And also you can change who's in charge of that company far more efficiently and easier by just appointing and resigning directors
On the asset portal.
in the space of 10 minutes or 5 minutes, as opposed to the example I gave before. Whereas if I was stepping aside, that requires a whole lot of application through to land titles office and questions about, has the property been sold? Is there stamp duty payable?
Stamp duty.
It's just cleaner.
Cleaner, easier to simplify over a longer period of time.
So if there was a trustee company of John Pidgeon holding my brick, and Scott happened to be a director of that company, and Scott died, well, it's easy just to put a new director in rather than telling heaven and earth that there's a new beneficial owner.
That's right.
The other complexity to that is lending as well. So we probably won't go too deep with that today, but that's what a lot of people need to factor in. If they're buying a business and getting a loan at the same time, or buying a property and needing lending, they may have set something up and then, hang on a minute, I actually can't get a loan.
Yeah.
Too late.
You're right, and you've seen that, John. Have you seen some banks not support individual trustees?
Yeah, absolutely. Yeah. And I've seen it more often where I think people are just so sold on setting up a trust to buy their assets in that they haven't looked past first base to say, well, can I get a loan? Well, yeah, you can get a loan, but you've got to satisfy X, Y, and Z. Or hang on a minute, that's going to be too complicated and it's maybe not going to work for me. Now we have to backtrack, but we've already spent thousands of dollars setting it up.
Yeah, totally. So we will just quickly talk before we go into what assets a trust can hold about this unit trust scenario.
Yep. Look, I was just going to say the main difference between the family or discretionary trust is, as we said before, if $100,000's earned, every year the trustee can make an assessment of which beneficiary receives that $100,000
at the trustee's discretion.
At the trustee's discretion. So it can be $100,000 to one, it could be $1, it could be it can be a complete mix. Can go to grandma, Uncle Barry, brother,
ultimate
sister.
flexibility for tax returns and planning at the end of the year.
Yep. That's right. Flexibility.
Where if you're a sole trader, it all landing on your own tax return.
That's correct.
If you're a company, it's any profit it's getting taxed at the company rate.
That's it.
Or going to you as an employee direct to your tax return.
At your discretion.
At your discretion. But it's still not as flexible.
Yep, not as flexible. The unit trust is still a trust and has all those governance structure points that we said before, except instead of discretion, the trustee must distribute the profits, being in this case the 100,000, to the unit holders in light of what number of units they hold or what percentage they own.
So if John, the trust holding that brick, if it was a unit trust and I owned 500 units and Taylor owned 500 units, the trustee basically goes, oh, well, at the end of the year, that $100,000 must go 50-50 to Glen and Taylor.
That's correct.
Because they're the unit holders.
Can't be kept in the unit.
No.
No.
Where my financial planning business, the Glen James Financial Planning, was a unit trust, 100% of those units were owned by Glen's Discretionary Trust.
Yep. So then you might ask, well, when are the instances, or when would I potentially use a unit trust as opposed to a discretionary trust in light of the fact we just said you remove flexibility? The primary probably situation you see it, and John, you may have seen this, is when you have sort of joint ventures. Yep. So you may have a situation where two people want to do a property transaction. Individually, they don't have the resources or the capacity or the ability to do it. So what they do is they say, well, how about I contribute 40%, you contribute 60%, and therefore they want to use a trust structure. So they may say, then we can own the units 60-40. Okay. The other point could be if there's a level of borrowing. Sometimes banks are a little bit more comfortable if there is a fixed entitlement, which allows a level of gearing into those entities, or even outside of that is probably when you have probably more arm's length, unrelated parties collectively investing into something, like a lot of large investment trusts, you usually find they're unitized structures, which gives the investors the protection that they know what their ownership interest is, as opposed to, like Glen may trust me to make the right decisions on behalf of his family, but Glen's 50 friends, if they're putting money in, they might go, we don't even know this guy.
Yeah,
so,
that's right.
And I guess for my own personal situation with the Glen James Financial Planning business, the reason that was a unit trust is if it grew to the stage and I wanted a business partner, I could sell them 40% of the units.
Perfect.
And then that doesn't affect anything else that I've set up.
Yep. So succession as well.
It was absolute flexibility, which it just goes to, I think, and we'll just touch on tax again before we go to the types of assets. Let's talk about capital gains tax. So this brick that John's holding on trust is a viable business, okay? So we'll just change it to that brick is basically a barbershop.
Yep.
There's 12 barbers over 2 locations.
Yep.
It's worth $1 million.
Yep.
Okay. If John was to sell that brick, well, if I'm the barber, I guess, if I wanted to sell the brick and the business, because trusts don't pay tax, we can get the usual capital gains tax provisions and they can flow down through to the beneficiaries. Is that correct?
That's correct.
Now, the difference was if that brick was housed inside of a company and we sold that asset inside the company, capital gains tax, the 50% discount doesn't exist. You're straight up
gone
company tax rate.
That's right. And then the problem you have is then usually, depending on what the plans are for that corporation and its directors, is the money's got to get out of the company.
Yes.
Yeah. So unless they're planning on reinvesting it. But fundamentally, you're right. So it's there, and then if they wish to pay that money out to the shareholders, so the shareholders finally get the money, there could be top-up tax there as well.
Yeah. So I'll give you a real-life example. We did a joint venture a couple of years ago. We set up a unit trust. There was 4 of us. So we're all directors of that unit trust. So that was easy for lending because lenders said, well, okay, we're taking in all directors' income.
Just one sec. The unit trust had a corporate trustee with 4 directors, or were the 4 people trustee of the unit trust?
They were trustees of the unit trust.
Okay, so they didn't have a corporate trustee?
No.
Okay.
No. So we knew that it was a 2-year
Wild
exit. To then say, okay, lending's right. Upon profit, you've got the capital gains tax exemption after 12 months, 50%, and then upon selling, you've got the ability to distribute income 4 ways. So you've got the best of a lot of things to take into account, knowing that it's a short-term play as opposed to a set and forget strategy.
Yeah. And in that case, John, each of those, you said 4 unit holders.
4.
Each unit holder could decide how they wish to hold their interest depending on their own situation. So one unit holder may decide to say, I've got a family trust. I want my family trust to own the units.
Yeah.
Another may say, look, I have a spouse that doesn't work. I want them to own it. Another may say, I'm happy to own it in my own name. Right.
And the other might say, I've got a bucket company that we've had it for 1 million years that it just owns everything.
Yeah, so some asset protection there.
Yeah, but what it allowed you to do is facilitate flexibility by each individual's individual circumstance into that one project to achieve a desired outcome that each of you then shared in.
Yeah. So I think it's just interesting to know that this is why if you are a business, you need the right type of advice. So if you're trading and there might not be an asset at the end to sell, it might work out better to just have a company because we don't have to have a capital gains tax issue to deal with later on. I think it's just, there's so many options. Now, another thing that's very important where, my lawyer liked the fact that I was trading out of a trust was because if there's any issues with the law, trusts aren't governed by the Corporations Act, which is basically what governs every company. So do you want to speak to that? I guess you're not a lawyer, but just from an accountant's point of view or just from you being a person in the world.
Yeah.
And
look,
that.
ASIC obviously governs corporations in relation to the Corporations Act. It is complex. It is more an area of law, but primarily there's individuals or organisations that structure themselves to stay outside the realms of that. An example is for you when a company meets certain obligations in relation to size or number of employees. It has reporting obligations that can make its financial affairs publicly available. So there's many private business owners that primarily they're in private business because they want their affairs to remain private. Equally, there's a whole lot of complexity in relation to insolvent trading, okay, and what that could mean. No one goes into a business thinking or with deliberate intention for it to go bad, but often that can eventuate. Yeah, and therefore there's other complexities in relation to obviously ongoing ASIC obligations where people often say, you know what, I feel a trust just is better suited to what I'm trying to achieve.
Yeah, and I guess another way to look at it, if there was an issue with a company, they just open the Corps Act and go, yeah, black and white, this company did not do this, you're done.
Yeah.
Trust law, it's based on precedents. Okay, so has there been a previous precedent of something happening throughout the court system? Yeah, it happened there. It was slightly different, so there's a bit more wiggle room. So,
and probably it's good point. It's probably that also governance can be customised. Yeah. So Corporations Act governs all corporations in this country. A trust deed, upon its initial preparation, can be customised according to whatever you wish with full flexibility. So you may say and define person XYZ is never to benefit under this trust.
Yeah.
Right? You may say or be less prescriptive. You may say it can only be these 2 people forever and a day. Right?
Yes.
So you have the full flexibility to set it up to meet your own affairs. Whereas on the other side, Corporations Act does say every company must meet or adhere to this legislation.
Yeah. Yep. So again, that's what you just need your own advice. Now, on the beneficiaries thing with the discretionary trust, if income it was producing that much where Taylor and I were receiving from this brick where we've pretty much capped out 500 grand each and we're at the max tax rate each of like 50 cents in the dollar, it has the provisions where we could set up a bucket company that we effectively benefit from, and we distribute the profit from that brick into that bucket company. So then that bucket company, we're not paying more than 30 cents in the dollar.
Yeah, that's correct.
So,
and that tipping rate is really 32.5 cents, isn't it? Like once you're over that rate, you can allocate into another company at 30 cents.
Yeah, well, basically, I think it would go back to, and I'm not an accountant, that's just a total sidebar. Do you I like to work out effective tax rate, where some people look at just the scale and go it's pretty crazy.
Yeah, look,
anyway.
no, but it's a good question. Look, we always like to say effective or average tax rate, right? So to the point where you said, Glenn, and John, if a family group can maintain and minimise within the rules and regulations an effective or an average tax rate below a certain threshold, that's often a good goal and objective to have every year, right? And then what most importantly is, which is true, is that under a marginal tax rate system, if someone earned $1 million in 1 year and nothing for, say, the next 9 years, whereas if someone earned $100,000 a year over the 10 years, the person who's got the annuity-based income with a marginal tax rate lower over the whole year will end up paying a large lesser sum of money.
Yeah. Yeah.
So the arbitrage of benefiting and smoothing it across a family group can be very material. Hence why you see at many points in people's lives, maybe not right now for a number of our listeners, but it could be, that's why people do set up these structures. Because managed effectively to meet the goals and objectives, the outcomes for the family unit can be material.
Yeah, just on that, that just sparked my reminder of a person who's in an industry that does cost income averaging. So over a 4 years or 5 year period, they if they earned their
so like talent or farmer.
I was going to say it'd be like a sports person.
Yeah, so they earned 500K 1 year and then 30 grand the next and.
Because that's exactly right. So that's the actual ATO acknowledging that there are professions whereby your income is very lumpy. You know, you're the hottest talent one day. You're back on you're nothing the next.
Taylor Swift.
Hey, you leave my gal alone.
And farmers are the other one too. Which we know they can go through years of drought. And then have one great season and then go through another bumper season, and then they go through another 4 years of not much.
So I want to move on to two things. Well, three things. The first one, for those listening who might be in law or accounting, you're thinking, oh, Glenn, you've missed two key things of a trust. I'm just going to mention them now and move on because we're not covering them because it's just too complex. There are two other kind of roles in the trust ecosystem. The first one is the appointer, which is ultimately the person who appoints the trustee of the trust. Okay, so for me, it wasn't me. It was a family member who was just... Anyway, it's totally beyond the scope. So there's the appointer, and there's actually, when we start the trust, the settler. So somebody who comes along and puts the first bit of asset on trust for the benefit of Glenn and Taylor. So Bruce down the road, and that settler, Bruce down the road, he can never receive any interest from my trust.
Can't benefit from the trust.
He can never benefit from the trust. He rocks up with a brick out of the goodness of his heart, says, John, you're a trust now. Can you manage this on the benefit of Glenn and Taylor? So that's totally beyond the scope of this, but your accountant and solicitor will work you through those complexities.
Yeah.
So the next thing I want to just talk about, We'll talk about using trusts if we're both employees or not self-employed, but also family law. A lot of people, and I've seen it in forums on Facebook and groups, people go, oh, we set up a trust because if I get divorced and blah, blah, we can hide assets. So talk to us in your experience with family law and asset protection.
Yeah, so family law first and foremost, and look, I have had numerous clients go through divorce. For all the listeners, not something you ever want to go through. It's a complete look through, right? So there's no ability to hide or shift assets.
Yeah.
There's positive disclosures that are made along the lines of this list of assets and liabilities is primarily everything that we own or control or have the benefit of, and fundamentally that has to go to the family courts and be stamped, and my understanding is non-disclosure is a big risk in relation to that proceeding being challenged at a future date.
Yeah. So for example, yes, trusts can help with asset protection if you are in the line of fire with your work or something like that. However, if Taylor wants a divorce from Glen, which she'd be crazy to do that, but if she did, our trust, family law, and if there was little Taylor Jr. and Taylorette Jr., I don't know, family law would pierce any corporate veil. So we talk about a corporate veil, could be a company, it could be a trust, could be superannuation get thrown in the mix. Family law just look through everything.
Yeah, and look back, and good point. So that's the divorce side. If you actually come back to the asset protection side, as you just said, you may have a trading entity, and then often in a lot of families there's two individuals, spouses. They wish to accumulate wealth outside of the trading business, okay? Because everyone knows commercially there can be risk with that. Risk assessment's different depending on your industry or size of business and scale. The trust can help as a way to build and manage investments or assets or wealth over a long period of time, which isn't linked to the corporation, isn't linked to the individuals who may be the directors or the advisors in our instances, and therefore you have a separation, a clear separation between who's conducting what and where assets rest, where wealth rests. Now, usually you find this is purely just risk mitigation. Depending on the quantum of the assets, the type of industry that you're in, hence why looking at one's goals and objectives and what industry and where they wish to go and how much they've got today, but also tomorrow, is important. One attribute that you need to consider in relation to whether a trust will help them or serve a purpose. But what you said before, Glenn's right. If you can minimise the downside risk in relation to if things do go bad, and we're now sitting here. And there's a lot of volatility in the world, right? Like a lot of business owners didn't expect this. Okay, they didn't expect it, and it's outside their control. So asset protection strategies there help, and you still have the flexibility, like you said before, in relation to allocation of that income across a family unit.
Yeah, totally.
I talked to a lot of accountants, including yourself, over the journey, and I think. Yeah, you've got asset protection, you've got tax minimisation, all those things, but essentially nothing's bulletproof, is it?
Absolutely.
A lot of the final comment of most accountants is, well, this is all great, just don't get divorced.
You're absolutely right, because it's all looked through.
Yeah, that's right.
Yeah, so if I can just go back one sec before we get on to assets and whether employees can use trusts for their assets. One of the things... and I've totally lost my train of thought. It was around... yes, lending. So if you're self-employed, this is why you need a bloody good mortgage broker if you want a home loan. So when I was going for a home loan, 1 year, for example, last year, Glen and Taylor could have received $50,000 each of that $100,000. So one lender would go, because the house is going to be in your name only, Glen, we're only going to allocate that $50,000 that you've earned. Yeah. But the other lender that I went with, they're like, oh, well, we know it's a discretionary family trust. Yeah. And I think we just did a letter or something to say, look, that was, we intend to use our discretion next year that Glen would receive the whole $100,000.
Yeah.
So some banks or lenders, even though it's a discretionary trust, and they call it an add back. some won't add back the income that was distributed to Taylor to me if the property wants to be in my name.
That's right. And the percentage of add backs too is critical.
So that's a whole other wild journey. But again, that's why you need a good mortgage broker.
Totally.
If you are self-employed.
And back, look, John, you made that point before about, you really should understand what is my investment objective. Is there debt involved, and should I? Because you can always talk to before setting up a new structure. You can always talk to the bank about is this suitable and will this be accepted by credit?
Yeah, and I think commonly you don't want to be sitting there thinking, well, I'm going to set up this business, this structure. So that puts me out from buying any assets for the next 5 years because banks won't lend. Like, that's just false.
Yeah.
You've got the ability. Like, there's lenders out that will take 12 months worth of business income only if you've only been operating 12 months. So where's a will, there's a way. You've just not, as you said, got to be aware of it from the outset.
Yeah. So let's now assume that Glen James and Taylor Swift are very happily married. Okay.
Of course they would be.
We just have a hoot. Us two, anyway, I'm just so in love with my wife.
We all are.
So in another world, Taylor, she's a full-time anaesthetist, employee, not self-employed, okay?
Ooh, she's a risque.
Yeah, so she's a full-time employee. I'm also a full-time employee at Bunnings because I wanted a job there, so I know where everything is. So we both earn okay money, but we've got no desire to be our own boss. Do we need, or can we set up a trust to buy property, shares? Can we do that?
You could. The question would be is probably should we?
Yes.
Yeah. So look, that probably depends on a couple of things. One, again, would be risk mitigating. So do any of us have concerns in relation to if we accumulated wealth in our own names? Now, remember, everyone has different risk profiles. Like I might say, I do have an issue with that and I don't want to do that, and therefore I want to have a structure. Whereas you could be sitting there and be the same advisor from the outsider carrying the same level of risk, but you go, that doesn't bother me.
Yeah.
So there's that. Then you got to go and say, okay, if I did do that, will there be a level of borrowings into it or financing? Because I think that's an important point that we need to say, because a lot of property transactions, and John, maybe you can talk to this, often they are run what we call negatively gearing, right? I know you've done discussions about that. If you have a loss inside a trust, the individuals earning the employment income are not receiving a benefit of that negative gearing.
So the loss in the trust can't be flowed through to the beneficiary's tax return.
That's correct. It's captured in the the trust.
Okay, so what we're saying is Glen and Taylor, both employees, no intention to ever be self-employed. We can actually set up a trust if we want for long-term wealth creation. Not a problem. We can.
You could. I'm sorry, I missed the point about the employee situation too. Look, that de-risks one's situation because you're not carrying on in your own right. So you're basically sitting under your employer, who should be appropriately insured, be under the Department of Health, you're not exposed to that.
And it's just funny, because people, I see in these online, Facebook groups, people go like, oh, we're going to set up a trust to hold our shares. I'm like, okay, number one, so he can or she can distribute the profit of the shareholding to the other spouse.
Yeah.
That could be an option. But I'm thinking you would only do that if you had significant wealth.
Correct.
And one of the employees might be seasonal work and lumpy income year on year.
Yeah, because in your situation, if you had differences in relation to how much you're earning in salaries and wages, and you had some cash to invest that was going to generate income, you could just set that up in your personal name or one of your personal names, as opposed to setting up a structure.
So one of the arguments I get from people is, well, okay, I want to set up a trust to buy an investment property in, right? I realise that I can't have any flow-on negative gearing effects in the years that I own the property. However, and I'll take care of that through the cash flow of my own life and other assets, etc. But upon selling, I'll be able to recoup all those negative funds that I'd paid out throughout the 10 years that I held the property.
Yep.
What's your thoughts on that?
Okay, so just on that, you're saying the losses can stay in the trust and be used for the sale of an asset.
Yeah, when you finally sell.
Yes.
So the losses aren't lost.
Yeah.
They're just carried forward.
They're carried forward, yeah.
Look, I'm always a bit, the bird in the hand versus two in the bush, right? In that case, if it is in that entity, they're forgoing cash flow today.
Yes.
For cash flow tomorrow. If they're only ever going to distribute to themselves, like which if you actually look at, I don't know the statistic, but probably 80% of family trusts really only distribute to closely held immediate family members. Yeah. So in that case, the individuals could have held that property in their own names.
Yeah.
Okay. Obtain the negative gearing deductions each year. Which gives them cash back immediately. When they sell the property, they're going to pay the same tax unless one of them has disproportionate incomes grossly different to what.
Yeah.
Yep. Because at the end of the day, the trust is going to have to distribute that to the individuals anyway.
Yes. Yeah. So in Glen's example of working at Bunnings versus anaesthetist, right? The anaesthetist might run their own business.
Yeah.
So they're maybe higher risk, aren't they, to be for litigation and everything else? Glen's pretty safe at Bunnings.
Yeah.
So in an ideal world, who needs the tax benefits there? It's definitely the anaesthetist earning the substantially higher income. But you'd want Glen as the title holder, wouldn't you? And keep Taylor well away from the property from an asset protection point of view.
Yeah.
So there's this really juggling act. You can't have the best of both worlds, but you can find something in between.
Yeah. And I would probably say, as a broad brush stroke, there's probably only 5 to 10% of the population who are employees who are having a decent sized investment portfolio that would need a discretionary trust for that.
Yeah.
I mean, sure, line in the sand today, if you've got over 400 grand and it's growing and you're like under that, why would you bother? Because remember, you might have to pay $1,600 a year for the tax return of the entity.
Yeah, it's high cash flow portfolios only, really. Isn't it?
And I just think don't overcomplicate it.
No.
Like,
keep life simple. Like where you can.
Simple. Yeah. And then all these people, like, it's just extra paperwork in your life. And the big thing why you probably wouldn't do it for property as well is if you buy a property, particularly in New South Wales, what's the land tax threshold? $650 or something?
Yeah, about that, yeah.
In a trust, that threshold reduces to 0.
Correct.
So you're paying land tax from day one because you don't own the property, another entity does.
Yeah, and to get lending in a trust has become harder and harder in the last couple of years as well.
Totally.
So people only realise that at the 11th hour.
Yeah.
So in wrapping up, because you've got to hit the road, Scott, a trust can own shares, property, a business. So my discretionary family trust, it has a share portfolio. Like there's ETFs online that it owns.
Yep.
It owned a financial planning business.
Yep.
It now owns the podcasting company. So for me, my discretionary family trust, because hopefully I'll always be a self-employed person, this family trust for me is my wealth creation vehicle for life. It's not going anywhere. It's called a random name. So if someone wants to dig dirt on me, it's very unlikely they would find it.
Yeah.
But as things come and go, I might start a business and sell it. That will go, that company, that trust. So it's just a bit of a choose your own adventure. And for me, it gives me the ultimate flexibility.
Yep. And then the choose your own adventure, the only proviso on that is as long as the trust deed says those things. But you're absolutely right. The trust deed can state all those things that you have the right to be able to do.
Yeah, great. So remember, jump on, have a look at the image. We'll put it back up on the screen now, and there'll be a link in the show notes to our simple diagram. Now, Altus Financial, do you help clients all around Australia?
Look, we're New South Wales based, so primarily.
Would you prefer local only? Or?
Wrong answer.
No, look, no, not at the moment. Look, as you and I and all those guys know, it's technology.
Yeah.
Right? It's just primarily about the client's experience and how much they want or expect a face-to-face contact versus the virtual offer. Right?
Well, I think there'll be more virtual meetings going on with this.
I absolutely agree.
So.
We've all got to adopt a virtual mentality.
So,
right?
yeah, so if you want to head to altusfinancial.com.au, Scott and his team, and I just really will stress, it's all about if you're in small business and you are a sole trader and you're starting to maybe carry some risk or employ somebody or just move up just from somebody who owns their job. Okay, so it's not a bad thing, but if you're a tradesperson who is just earning a bit over normal income, you own your job. That's not a bad thing. If you wanted to sell your business, you could probably only sell it for the equipment that you've got.
Yeah.
So, but if you want to go, I'm a tradesperson, but I want an empire. I want to be the biggest X in my area. I want multiple vans. I want multiple employees. I want my little thing. Yeah, sure. Then we go to Scott. Hey, this is my growth horizon. This is my plans for the business. What do you think's the best entity?
Yeah, or even so, Glenn, for if listeners have been told they should set something up because there's benefits to it, I'm happy to bounce around ideas about, or with the team of, does it truly make sense? Because it's really easy for, I'm not saying most advisors are great advisors, but it's really easy for people to get caught up in, I heard a friend who told me I need to because there's a great benefit to this to me.
Yeah.
But potentially the complexity and the cost is outweighing the actual benefit.
Yeah. And I think stressing back to the empire, regardless of whether you want to build an empire or not, I think we should all be thinking, what's it going to look like for me in 5 years, 10 years, 15 years? And then you can work your way back to this next decision, can't you?
It's completely true.
And I think as well, it's like you've just got to, because life's full of risks, you can't control everything, but you got to be like, okay, over the next 5 years, I want it to look like this.
Yeah.
So I'm going to go 80% chance it will hopefully look like this. So I'm going to make all my decisions based on the majority, the likely thing.
Yeah.
If it doesn't look like that, well, there are some downside things like, if I set up a company, I'll give you an example. Like you might say, look, I want to set up a company or incorporate rather. I think year-on-year income is going to be the bigger deal for me. So I'll just set up a company so I can just get the company tax rate. I don't really need to worry about selling that going concern because it is just me generating the income, blah, blah, blah. But there is a risk that in 8 years' time, in 5 years' time, that you have grown it to something worth something. Well, if you did sell it, that's just you don't have a capital gains tax.
Yeah, and look, John, I think you're right. Like you should be, and same as you, Glenn, you can only make an assessment or a decision based on what you know today. And you're absolutely right. You should be looking at the goals and objectives. And then fundamentally, my view is always the structure should be the optimal structure to support you achieving those goals and objectives.
Yeah.
And so structure should support what one's trying to achieve.
Yeah. And it makes the likes of your job easier because I've just told you what I want to achieve.
Yeah.
Reverse engineer it and let's get it done.
Yeah.
And also, there are some chances where different governments, there could be exemptions if you want to change entities. So, for example, if John was holding that brick inside a company and we thought, we want to change entities or whatever, I know I'm going beyond the scope, but if I held shares in that company and I wanted to change, because when you sell a share in a company, you might trigger a stamp duty, you might trigger tax. There can be some rules. You can tell I'm not an accountant by the way I'm saying this, that there could be stamp duty exemptions for moving entities and whatnot.
There can.
Yeah.
But again, I always come back to that's the uncertainty, right? Like one might sit here and go,
yeah, you can't plan based on legislative risk.
But also how successful you're going to be.
Yeah,
but
totally.
Equally, you might get 2 months in and then actually go, hang on, this is going better, faster than I could have ever imagined. So you could dovetail and change structure there as opposed to getting 2 or 3 years down the track and then going, oh yeah, I knew this was a success. I've been going really well 18 months ago. Like, that's probably the advisor-client relationship where they should be in constant dialogue about it. Correct. So then you can tilt and adjust accordingly at its earliest possible point.
Totally. All right, Scott.
Thanks,
you
Scott.
so much.
Very
That was a banger, and you can see why we couldn't just tack in that little segment at the episode 257. And Scott Young from altusfinancial.com.au there to help.
Thank you, guys. Thanks for having me.
Bye-bye.
Bye.